Welcome back to Financial Fortitude. I'm Michael Acosta here with my co-host Brady Hemmerly. If you've been keeping an eye on the stock market lately, you've probably felt a bit like you're on a roller coaster, except without the fun part. Volatility is the name of the game right now, and today we're diving into what you should be doing with your investments based on where you are in your financial planning journey.
That's right, Michael. Whether you're just getting started, mid-career and building wealth, or closing in on retirement, we've got strategies to help you keep your cool and make smart moves, because burying cash in your backyard is probably not the solution.
Exactly. We'll break down actionable steps to help you navigate this turbulence with confidence, from rebalancing your portfolio to tax-efficient strategies and everything in between. So grab a coffee, get comfortable, and let's turn this market chaos into opportunity. Welcome to Financial Fortitude, a podcast for high earners, families, and business owners. We are your hosts, Michael Acosta
and Brady Hemmerly. Each week, we bring purpose-driven financial guidance to you so you can be assured you're on the right path. If you're looking to become an extraordinary wealth builder, let's dive in. Alrighty, Michael. Well, I am very excited to talk on this topic today because it's timely. Some of our episodes are a little more evergreen, and it's exciting to actually speak on maybe not day-to-day specific events, but things that clients are hearing, seeing, things that we're actually having conversations on day in and day out.
Well, I find it ironic that we find this to be an exciting time to have this conversation because I imagine a lot of you guys out there are not as excited, right? Especially depending on where you're at in the apex of your financial journey, right? Are you on the left-hand side, more so the accumulation journey? Or are you more so on the right-hand side where you're in that deaccumulation phase or retirement distribution or your golden years where you're spending the wealth that you've accumulated? Depending on which side of the aisle you're on could definitely impact your overall emotions while, the U.S. market's pulling back 5% plus or minus.
So yeah, let's talk about that. Let's assume that we're in the first half of our career journey. What kinds of things are you hearing from clients or perhaps even in the industry as to what current market volatility looks like and how it affects our clients?
Yeah, when you are further away from exiting the workforce, further away from retirement, there's less anxiety for the most part, assuming you're paying attention to what's even taking place in the markets. There are so many distractions in your day-to-day life, especially if you're married or you have children or if you're a business owner, to where what's going on in the market is almost background noise. It's not front and center because you recognize like, hey, I'm not retiring tomorrow. The probability is less than zero that I'm exiting the workforce tomorrow. So what happens in the market doesn't necessarily impact me today or tomorrow. So it's less important, if you will. Now, some of the conversations that are being had with clients or even that we're speaking with some of our strategic partners is, hey, this could be a buying opportunity, especially if you're sitting on excess cash. And again, you will want to consult with your financial advisor, financial professional in your world that you trust, and do your own due diligence and research as to whether or not this makes sense from a putting more cash into the market standpoint. Only because if we think about it, about a month and a half ago, the market was trading at an all-time high. Right? And if we just experienced somewhat of a 5% pullback in the market, what does that mean that the market's trading at now? A discount. So if we just think about outside of the stock market as a whole, when some of our most favorite things that we spend money on are at a discount or being priced below MSRP, what do we typically do? We go out and buy more. We feel less cautious about spending the money otherwise because, hey, we're getting it for a bargain. But when we see the red on the ticker with the stock market, it's a different emotional behavior that takes place. And we almost become more reluctant to step into the stock market when in reality, you're almost taking advantage of an opportunity to buy low, which is really step one in a successful investment strategy.
See, let's set the stage a little bit there because I think where we're headed in this conversation is kind of twofold, at least on the accumulation side of the mountain. And what I mean by that is for individuals who are typically mid to late 20s all the way up into perhaps early 50s, what we typically see from an attitude perspective is either one, I'm completely checked out or just not bothered whatsoever by market volatility. There's no changes whatsoever. And really, there's not a call to action to give my financial professional a call. But on the other side of the coin, we're still accumulation focused, but we're speaking to people who say, is now the right time to invest? Right? Should I consider to have, or should I still have the same confidence that I had maybe 6 months ago? And I think the easiest place to start for many accumulation clients is kind of setting the landscape as to what investing looks and feels like over a longer term time horizon, or more so year to year rather than day to day. So Michael, what context do you have when it comes to investing over someone's career? Like, what does that look and feel like from a ride's perspective, if we've used the roller coaster analogy up to this point?
Yeah, so being someone who very much does not enjoy roller coasters to begin with, using that same sentiment when having this conversation, over a long haul, markets actually favor volatility and actually favor being positive more often than being negative. Okay. So first and foremost, to really set our philosophy in place, we don't agree with or subscribe to trying to time the market. We believe in long-term investing. We believe that markets are efficient. Now, at the same token, we're not passive in the sense that we're just going to sit on our hands when the world around us is going sideways and falling apart. If there's an opportunity to improve a strategy, we're going to take a proactive approach to improving our overall defense ability of the strategy, or our opportunity to catch it on the upside when the market corrects. Now, if we look at the S&P 500 as a resource or as a reference point, right, and we look over a long period of time from 1937 to 2023, that's a total of 86 years. Okay, and there's this great piece out there that Franklin Templeton put together, and it's titled The Rewards of Long-Term Investing, Investing Principles. What it actually presents is that from 1937 to 2023, the average annual return for the S&P 500 is about 10.5%. Okay, so when we hear clients or friends or people at barbecues or get-togethers talking about, oh, well, I'm invested in the S&P because it averages 10%, this is what it's somewhat referencing, or what they're referencing or referring to, right? Because they've probably heard this somewhere and they're parroting it. Now, over that 86-year time horizon, the S&P 500 has been positive 66 years out of the 86. That's great odds in my mind, because that's close to 77% probability that the S&P will finish the year positive in some capacity, right? Just above 0%.
And then from a negative standpoint, that is the other 21 years. So what does that look like on average, or what we see more frequently?
Yeah, and so the 21 years where the S&P finished the year negative, the average negative return was about 12.5%. Okay, now of those 21 years where it finished negative, there's roughly 15 years where the S&P finished down as low as 12%. Okay, so anywhere from 0% to 12%, it finished the year down. And again, that's 15 years out of the 21. So that's the bulk of it from a probability perspective. Now, going back to the upside, again, about 77% that the S&P is going to finish the year positive. Of those 66 years, the average positive return was about 19.8%. So again, if we're looking through the lens of a long-term investor, these volatile times where we have an intra-year pullback in the market shouldn't spook us to the point to where we're wanting to make drastic adjustments or emotional adjustments to our portfolio. It's really an opportunity to speak with your financial professional and have a conversation of, hey, how is this impacting our current financial plan that we've been working on? Are there any opportunities at hand that I should consider, or do we need to think about becoming more defensive than what we already are?
No, I think that wonderfully sums it up. At the end of the day, the conversations that we're having with many of our clients are looking at the investment landscape over a longer term time horizon and essentially educating and saying, well, hey, here's how things look, or here's how the game is played. For every year that you roll the dice, and I don't want to gamify this too much, because truly, you're not rolling the dice, you're picking and choosing, hey, what you're invested in and why. But if we've got a balanced portfolio, if we're mostly in stocks as a young professional, or even a high-earning young professional, 2/3 or more of the time, you end up positive. If, Michael, I came to you and said, hey, we're going to play a game together, we're each going to flip a card over, and 2/3 of the time you're going to win, and 2/3 of the time I'm going to win, both of us are going to play the game consistently. Now, what I'll also promise in the game is there's going to be plenty of losing years. Here's what you might average, negative 10 to 12% in most circumstances. And you'll average close to 20% in most positive circumstances. Are you interested in the game? Well, of course, the answer is going to be yes. Right at the end of the day,
or it should be, right?
Yeah.
Or it should be.
I'm interested in the game because I know all I have to do is keep playing to experience a longer-term positive result. And that is really the frame of which we're building our investment approach for clients, is that, hey, we're really not investing to accomplish all of your goals next year. We're investing to help you accomplish all of your goals in the next 10 years, in the next 20 years. Could be 30, 40, 50, depending on where you are in that accumulation journey. So big picture, when we have clients come to us in that early to mid accumulation saying, hey, is now the right time to invest? Now should I be taking risk off the table? Should we really be reinventing the approach? It's just framing and saying, no, this is all part of the roller coaster. It's all part of the game, the journey that we're playing. We're confident that, hey, now is the time to examine what our whole situation looks like. Can we rebalance your portfolio to dive deeper into stocks at a discount, like you mentioned earlier? Is there an opportunity to look at the current stocks we have, perhaps harvest things for losses or just readjust the portfolio slightly? But knowing that, hey, the name of the plan or the name of the game that we've built in our plan is this longer-term participation in the markets themselves.
Yeah, well, so we've touched on, or at least started this conversation today on longer glide paths, right? Or longer time horizons for, let's say, the early to mid-career professionals who are investing in the market and taking advantage of opportunities. How is it perceived, or what are the emotional effects of someone who's maybe a little bit closer to exiting the workforce and starting their retirement, right? Starting to come down the mountain on their financial journey? And does it shift, or do we still focus on a long-term time horizon with which how we're building the portfolio and how these equity returns in the market are really playing out?
It's a great question. The financial advisor, of course, is always, it depends. I would say big picture, what we hear from clients, from individual investors who find themselves right on the edge of retirement, perhaps just into retirement, or maybe even so, hey, 5 or 10 years in, is I hear two different things. I hear, hey, I've been through this before. I know how this whole thing works. Or the primary concern that I now hear is I don't have as much time or enough time anymore as I did when I was that younger mid-career professional. We've got to completely re-examine what we're doing. So it really depends, right? For those clients who voice, or those individuals who voice, hey, I've been through this before, they've had some of that coaching. They've understood the benefits of taking that longer-term time horizon, even in retirement. For those clients who are either newer to the game or just perhaps now a little bit more conscious as to the volatility that exists in the market because their portfolio's driving what their world is going to look like income-wise, that's where we really have to examine how is our portfolio built, not only for us and for our income, but how is our portfolio built from a protection standpoint? What's my allocation? What other income sources do I have, right? How do we better frame this shorter-term market volatility in addressing, hey, what's the bigger picture of our world look like? And is this truly a cause for alarm, or just simply some of that normal volatility? We're just paying a little more attention to it.
I love that vantage point on this. And I want to quote somebody, and this is someone who I believe would be considered like a godfather of retirement planning within financial services, right? So Wade Pfau. And so Wade Pfau has some very compelling research out there. And I'm going to reference one article that quotes him by MarketWatch entitled, "This surprising investment strategy could boost your retirement nest egg, but proceed with caution." In summary, what this article or blog post talks about is Wade Pfau's train of thought for retirees, that instead of taking a traditional approach or conventional approach to declining your equity exposure or how much stock you own in your portfolio during retirement, right? Because if we think about it, the stock is where your growth opportunity comes from, but also where your volatility comes from, your risk. the variations in your returns or your account values, similar to a roller coaster, the ups and the downs, based on how the market performs. But what he explains is that there's really this glide path that should be considered for investors that are in retirement, to where the further along you make it into retirement, the more potential equity you might want to include in your portfolio to be able to sustain risk longer term. But also, while in retirement, this approach could lead to the opportunity of reducing the sequence of return risk. So it almost aims to protect the portfolio during not only early years when there's more vulnerability of retirement with market downturns, but also helps with longevity or the success with your money having a lower probability of running out based on you having a longer life expectancy.
So simplify that a little bit. Like, what does that look like for your average retiree client? Like, how do they implement something like that?
Yeah, so this is something that you would want to talk with, your financial advisor. And conventional wisdom would say that, hey, when you get to retirement, let's just think about a target date fund that you've opted into, in your 401k or your 403b or your 457 plan, right? Depending on where you work. The way that those target date funds function is that the closer you get to retirement, the less equity exposure, the less quote unquote risk you're going to be exposed to, right? So they're going to start to reduce it the closer you get to your destination. I like to use the analogy of an airplane. The further away you are from your destination, typically the higher your altitude as far as your cruising altitude. Closer you get to your destination, you start to descend and you land at the airport safely. Same concept with your target date funds. So the closer you get to retirement, the less risk you want to have. And so it could look to where your portfolio flips to where there's 60, 70, 80% in fixed income, which are going to be bonds, right? Whether it be short term, whether it be municipal, whether it be corporate, each bond structure is going to have a different risk reward scenario for it, right? As far as potential growth and sustainability of it. Now, if you sit in a portfolio, Wade Pfau is basically saying, if you sit in a portfolio that's predominantly made up of fixed income bonds, especially with where yields have been for the last 15 to 20 years, you could run the scenario, especially if there's pullback in the markets or severe interest rate risk, to where your portfolio runs out before you pass away. Okay. Now, what you want to do is you want to protect the portfolio in the earlier years where, yeah, you can start off having a higher allocation towards bonds and fixed income. But as you progress through retirement, depending on, again, your health and your expected lifetime horizon, starting to push a little bit more out of fixed income and bonds and into equities. So it might look like something like, hey, you start retirement in your mid to late 60s with a portfolio that has about 60 to 70% fixed income and the 30 to 40% in stocks. 5 to 7, maybe 10 years down the line, you then transition to where it's maybe 50 to 60% fixed income, 40 to 50% equity. And again, the reason why you're pushing into the stocks is for growth, because you're not going to get the growth to help compound your portfolio in the bond allocation if it's too heavily weighted that way, right? You're basically losing purchasing power. Now, again, every advisor's philosophy is going to be a little bit different, okay, which is why financial planning is more of an art than a science. But that is one way from a retiree's perspective to be able to safeguard their allocations, safeguard their retirement, and not buy into this mindset of, hey, I have to be ultra conservative during this period of time because I can't take any risk. You might have to take more risk than you want to, honestly, depending on the amount of assets that you have allocated for you and your expected time horizon or your expected life expectancy.
Yep. No, it's just all about framing the conversation based on the resources that you have, the needs that you have, and the plan that's put in place. I mean, very frequently when I see market volatility and a client in the pre-retiree or retiree phase is truly worried, hey, I don't have the time to recoup these potential market losses, it can be as simple as just reminding them, hey, how is your portfolio, again, built? We have 1, 2, 3 years worth of spending in safe bonds. We have 1, 2, 2.5 years of spending like income in cash. If the market goes down time over time over time, how many years do we not even really have to touch our market side or our stock side of the portfolio? with that framework in mind, oh, that is right. I have some more assets set aside for this exact scenario, because we understand what the roller coaster ride looks like. We understand the nature of the volatility game year to year, knowing that 3, 5, 10 years later, based on a lot of data points over the last 86, 87 years, there's 60+% of the time, 65% of the time, right, markets are up instead of down. So again, when it comes to volatility, it's understanding that on a year-to-year basis, it's almost a coin flip. Is the market going to be up? Is it going to be down? And the coin rests slightly to green. More times than not, it's green. Over the course of a 10-year period, it's almost every time you flip the coin, it's green. And if we've got that context of, hey, I'm a younger professional, high-earning accumulator, we've got a lot of coin flips left. Even if we are a pre-retiree or retiree, there are still a lot of coin flips left. And if we've got the safety net built in income sources, in buffers, right, it's continuing to participate in that year-to-year volatility that's going to lead to greater success. So it's just reminding clients, what do we have in place and why? How does it affect your day-to-day lifestyle? And truly, I think the big summation of a lot of our conversations, it's tune out the news. The news is the effort of a lot of what we hear in media is just to get you to listen or to click on it. It's not necessarily about exactly what's going to happen a year, 3 years, 5 years from now. None of us know that.
Yep. And again, it's simplified. Just turn it off.
Yep.
Stop listening. Yeah. Focus on something else, something that has more direct impact in your day-to-day life or where you want to be, right? And it's an opportunity, again, to reach out to those who have your best interest in mind based on you working with them directly, as opposed to allowing your emotions to fall victim to the fear-mongering that might be in the headlines or in the blogs or even in the talk shows, because those individuals don't know you directly. They don't know your situation. And so when the fear of it all creeps in, that's when bad financial decisions can occur. And again, if you have a trusted advisor that you work with, use that opportunity to check in with them, get an update on where things are at, what they're doing for you. And if they're not proactively assisting you, then maybe that's a consideration for you to potentially interview someone new.
Oh, absolutely. Yep. It's those regular conversations that is truly the art and the value of having a professional in your world. So, Michael, I guess to wrap things up here, given that we're having a more timely market-based episode, give us some of your thoughts moving forward through the year 2025. What perhaps are we seeing from a growth perspective? What type of recommendations are we giving those accumulators, retirees? Is it worth staying in the market at this time? Like, knowing a lot of the stage that we set in the background that we gave, like, what's the thought moving forward?
Yeah, so as far as our view of the markets for the remainder of the year and what we're hypothesizing and building our strategies around specifically, we're very optimistic on the year despite this recent pullback. We very much believe that the economy is positioned for expansion, especially as we continue to track the inflationary data and see that it is coming down, year over year, month over month. Inflation was at its all-time high at about 9.1% back near August of 2022. And as of December 2024, closer to about 3%, right? And the source of this data and the remarks that I'm going to be sharing are from Bloomberg, as well as our strategic partner, AssetMark. And so we feel that as inflationary data starts to become more compelling, what that's going to offer is opportunities for the Fed, the Federal Reserve, to implement maybe 1 to 2, 1 to 3 interest rate cuts this year. Now, why is that important? Because as the Fed cuts rates, that offers opportunities for expansion for small, mid-sized businesses, even large businesses, right? It becomes a little bit cheaper for money to be borrowed and reinvested or spent on opportunities. Now, at the same token, the stock market is trading in the U.S. at an all-time high as far as, specific to like the S&P 500. And even though it's trading at all-time highs, the price to earning ratios, we feel like they're still compelling to where, hey, it still makes sense to be just as optimistic about the market and continuing to put money in when it makes sense for your financial plan, right? You shouldn't be doing it blindly. Everything that we harp on this podcast and from a planning perspective within our practices is that we need to be purpose-driven. There needs to be a rhyme to the reason to what we're doing. One other thing that we are recommending and informing our clients of is that diversification is still important. Now, you can be globally diversified, or you can be more isolated to a specific market like the US, for example. Now, if you're going to be more isolated to a specific market like the US and be just bought in to the US economy, well, you should definitely think about diversifying across large cap, mid cap, and small cap, right? Another way of saying that is large companies, mid-sized companies, and small companies, just understanding that each category offers different levels of risk and reward.
I think the big focus there is over the past year or two, it's just been win, win, win. Pretty much any investment that clients are making, especially in larger tech companies in the US, have just been gangbuster winners. And now we're experiencing a time where there's some uncertainty. Some of those winners aren't looking as high and mighty as they once were. But big picture, there's still a lot of opportunity. Growth is expected, even if slowed, is still expected. And it's important to have a more dynamic planning approach or more dynamic investing approach rather than just picking and choosing one stock that's been hot at this stage. So, Michael, to begin to wrap our episode here today, I think some summary points are, as always, the purpose of any financial decision and the framework of your own situation and your own plan is going to drive a lot of the strategy. At the end of the day, market volatility and investing is just simply part of someone's overall strategy. And it's very important that we understand, right, what typical investment looks like year to year and what typical investing looks like longer term. And with all that in mind, right, big things that come to the forefront are the importance of staying invested, the importance of having a plan, the importance of truly not acting emotionally. It's not our job as financial professionals. It shouldn't be your effort as individual investors to go out and just act based on how we feel, what we think might happen. So, big picture, right? It's having a plan in place that you can consistently herald back to and count on, especially when things are uncertain. And that in times of uncertainty, opportunities do exist, right? And working or examining what is out there, change-wise, adjustment-wise, strategy-wise, can make a big impact little by little over time.
Right. And at its core, it's really just having that open dialogue and awareness. Again, having some consumption of information, data, news is fine. But if you're glued to the TV or glued to the radio or glued to the swift blog posts or headlines that are coming out that typically scream, fear, then I would say take a break from that and just think about what could you be doing right now that could more positively impact your situation. And at its core, speak with your trusted financial advisor. That's what they're there for, right? Now, with that being said, that's a wrap for today's episode of Financial Fortitude. If you're feeling a little less panicked about the market and a little more prepared, then we've done our job. No need to hide your cash under the mattress just yet because, again, we're still very much optimistic about the outlook of the market this year.
And remember that volatility is just simply part of the investment approach and part of the game. The key is sticking to a strategy that makes sense for where you are in your financial journey and not jumping ship at every headline or every market crash piece that we see in the news.
So take a deep breath, maybe a sip of something stronger if needed than just coffee, and keep your eyes on the long-term prize. If you enjoyed today's episode, don't forget to subscribe, leave a review, and of course share it with a friend who could use a little less panic and a little more plan.
And as always, if you are looking for personalized guidance, if you're looking to speak on the context of your own plan, you know where to find us. And until next time, keep that fortitude strong.
Are you considering hiring a financial advisor? If so, be sure to listen to episode 1 of Financial Fortitude. In this episode, we discuss the reasons why many people choose to hire a financial advisor and highlight the key qualities you should look for in the financial professional you decide to work with. The This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Genesis Wealth Planning LLC, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. All scenarios and names mentioned herein are purely fictional and have been created solely for educational purposes. Any resemblance to existing situations, persons, or fictional characters is coincidental. The information presented should not be used as the basis for any specific investment advice. Michael Acosta and Brady Hammerly are registered representatives and financial advisors of Park Avenue Securities, LLC, PAS. Securities, products, and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Consolidated Planning Group, Inc. and Genesis Wealth Planning, LLC are not affiliates or subsidiaries of Park Avenue Securities or Guardian. Michael Acosta's California Insurance License Number 0M50974 and Brady Hammerly's California Insurance License Number 4353077.
7237198.4. Expiration 327.